Hello, everybody. Happy Friday. So today I wanted to talk about a question that I get pretty regularly of um, how much should I save for taxes? So this is a really good question that is very difficult to answer. Um, and that really comes down to a couple of things. So I read the book called Profit First. I love that book. I think it's a great book in theory. Application, it's a little bit off, but I am going to talk about that. But I think the problem with answering this question is I want to talk about some of the variables. So the biggest variable when you're a small business owner is whether the economy is going to be up or down and how much money you're actually going to make. And most people typically are growing every year or they're going out of business. I mean, we fluctuate obviously. So if you are on a decline, you're going to make less money and have to pay less taxes. And if you're on an increase, you're going to make more money and have to pay more taxes. And so that's one of the reasons why it's very hard to give a good estimate. So the rule is you're required to prepay 100% of last year's taxes. And I've talked about that in a lot of other videos, but it's really hard to say that because you might know based on running your business whether it's doing better or doing worse than the prior year, and why should you prepay a whole bunch of taxes if you're not going to owe it? Or, are we just going to guess and spend a bunch of money sending it to the IRS that you could have used to operate your business? And so general rule of thumb would would kind of come from the profit first mentality. So the profit first mentality says that every time you have revenue come in, regardless of operating expenses, you take your profit first. And so they talk about opening up 5 different bank accounts, and as you get a deposit, you get revenue, you then allocate that to the 5 different bank accounts. And one of those bank accounts is your profit. So that's why you would call it profit first, is you're taking your profit out of the revenue from the beginning. Another account is the tax savings account. Now in the book, they want you to save something like 30% of revenue, and that's where I disagree with the actual application. Um, Now, I think in the book they're trying to talk about sales tax, payroll taxes, and income taxes, but uh, ultimately the goal is we're minimizing payroll taxes through managing our payroll to ourselves, which I've talked about in other videos. And then our sales tax is a compliance tax. There's no changing it, and that should be taken out from the revenue before anything else, because it's not your money. It's trust money that you collected from the customer, so that gets remitted before it even really comes into your account, or it should be. Um, and so then all we really have is the variations in income tax. Well, like I said, we don't know if we're going up or down. However, if you're taking 30% of your profit to save for taxes, before we take into account expenses, that's going to be an issue when it comes to actual tax time, because in actual tax time, we're going to say, well, this was your revenue, here's a whole bunch of expenses, and then you're paying taxes on the bottom number, but you're saving 30% of the top number. So that spread is going to grow forever. And if you're putting money in a bank account, it's losing value over time. And so, I mean, if you're going to save 30%, at least put it in an investment account. If you want a good number, a percentage, I would say save 10% of revenue for taxes, because that's still going to be too much, because I'm actually targeting 10 to 12% for most clients to pay on your bottom line taxes. So like I said, your revenue minus your expenses equals taxable income. I'm trying to target about 10 to 12% of that for your taxes. And we typically can do that by redefining what our business expenses. So I do like the profit first mentality that we save money from our revenue to cover our profit, our wages, and our taxes. So the money is completely set aside before we even take into account business expenses. But if you are going to do that, you need to put it in some sort of investment account so that it's earning you capital gains, dividends, and interest instead of sitting in a savings account just losing value because of inflation. And so that's kind of my take on if you're going to save for taxes, how much should you save? It's always going to be an estimate. You're either going to estimate above or below. I don't prepay the government. I save it in an investment account to get capital gains on it before I give it to the government. And I would say 10% of revenue should be more than enough. If it's not enough, or if the market is down at time that you owe the taxes or we've calculated it and you need to pay it, then we start a payment plan with the IRS until you have the funds available to be able to actually pay off your taxes. Now, this video is referencing a whole bunch of other videos that I've done. This is just answering how much do I save. Personal recommendation. I'm not a financial planner. I am not a certified financial advisor or anything like that. My goal in life as a tax advisor is to lower your overall taxes. And if I'm doing my job right, you should never have to pay 10% of revenue to taxes because you should be paying hopefully around 10% to 15%, depending on how much income you have of your bottom line. But I'm referencing officer wages video. I'm referencing interest and quarterly estimated tax payments videos and a few others. So if you have questions about what videos to look at, I can shoot you the link to those videos. Just shoot me an email or comment on here. Or just look through the channel and you can see those other videos that I'm referencing. But yes, 10% of revenue is Jason's, not CPA Jason, just Jason's personal idea of a good number to save out of revenue for taxes. And that's kind of why. All right. Hopefully this helps everybody in coming up with a budget and answers that question for you. Till next time, have a great week.